On this video, we are gonna go through the financials of AstraZeneca, which is a pharmaceutical company in Sweden. Well, it's working in Sweden and I believe UK. Let's get it started. So this tool that we are gonna use in this channel is TradingView website. Let me go and show you their different plans that they have. So if you have the free plan, you will get access to 7 years of financial data from different companies. But if you want to get access to 20 years, you need to get the Pro account, which is what I have. So for a long-term investor, this Pro account should be enough. If you're a trader, yeah, maybe Pro Plus is good for you because you get access to more tools. I will put up a link in the description below. So let's get going. So my assumption here is that you have a good understanding of accounting. Otherwise, please comment below and I will try to make a video and talk a little bit about accounting because that's really important. Accounting is the language of business. So if you want to understand the business, you need to have a good understanding of accounting. What's a balance sheet? What's income statement and these sort of things. So here I have the different information that I believe are really important to filter through the companies. This is not going to be the final tool that we use, but this is a start. As I said, this AstraZeneca is a pharmaceutical company, and just with that, it's going to end up in the bucket of too hard for me. And I'm gonna just remove it. But since this channel is not for me to select companies, and this is for us learning together, we are gonna move forward anyway. Probably if you work at a pharmacy or something around that, you have better knowledge than me about these companies. You know what they sell. Are they better at production, advertisement, these sort of things than me? And that is really important to understand the business like that. So let's go through the financial things that I believe are really important. So first thing, it's the revenue. We will look at the revenue. And as you can see, back in 2004, they had 150 billion in sales. And something like 40 years later, they have 190 billion. That's not good. It was just flat for 14 years, which is not good. We want them to grow it 10% per year and be consistent. That's very important. So recently, in the past 4 years, they have gone up something like maybe 2.5 times. So this is something that we need to take a look. Why did this happen? Is this something temporary? Like here it went up and then it went down. Will it come down? Was it because of COVID maybe? They sold a lot of vaccines and later on they are going to come down. So this is something that we need to do more research on, and we will talk about where to do those researches. But right now, this is not good. This is a check that we will do later on. So let's go to the next one. The next one, we are going to look at the equity. Equity is the book value of the company. So assets minus liabilities equals equity. And it was almost flat too, around 150 billion. And in the past 2 years, it went up to something like 400 billion. So we need to take a look at this one too, to understand why it went up 2 times, more than 2 times. In the past 2 years. And in the right side here, we have more information about the company. One of the things that we will go on is this more financial. And here you have some other things to look at. But right now we want to go to the balance sheet, make it annual, and then take a look at the asset and liabilities. So as you can see, in the past 2 years, the equity has gone up. And let's take a look. So the liability have gone up something like 200 billion, but the asset has gone up 450 billion. So why did the asset go up? So let's take a look at these things, and let me just move myself around. And as you can see, the current asset didn't go up that much. It went up maybe 60, 70,000. That's not good. Out of 450 billion that went up, 60 was current asset. So the cash didn't go up. The receivable went up a little bit, and that makes sense because they sold more things. The receivable would be higher too. So that makes sense. We don't care about this one. The inventory didn't change that much. It went up and went down. So most of the things that went higher, it seems, were part of the net intangible assets. That's the asset that you can touch. That's not very good, because if the company goes bankrupt, these won't be sold for 600 billion. Maybe they will be sold for 100 billion, and the investor will lose money. And that's the rule number one: never lose money. So this is not good. Something like 60% of their asset is part of intangible assets. Maybe they have good trademarks and patents and these sort of things around their drugs. So that's something we need to take a look at, but 60% is too high. We want the company to have lots of cash, not lots of intangible assets that someone believes they're worth this much, because the buyer may not believe that. So let's take a look at the liabilities. There is this problem here with the current ratio. Current liabilities, the liability that the company needs to pay in the next year, is higher than the current asset, the asset that they have for the next year. So this is not good. They need to borrow more to be able to run the business, and that's not good. So their balance sheet is not very strong. And the other thing is their total debt. Their total debt is something around, it was 150 a couple of years back, now it's 300. So their debt has gone way higher, so twice as before. But their cash or current asset hasn't gone up that much. So this is not good. If something goes wrong, they can't pay their debt down. So we can go back here and take a look at their debt. So as we can see, yeah, their debt has been going up and up. This is not that good. And as you can see, they have been paying lots of interest on their debt. That's not good. They have been paying something like 9 billion. So out of 400 billion, we can go back here and in the statement here. So they had made this much of money selling the stuff, paid this much to create those stuff. So they're left with 300. Out of that 300, they needed to pay their salaries and advertisement and these sort of things. And they're left with 58 billion. And out of that 58 billion, they needed to pay 10 billion in interest on their debt. And that's not good. Something like 15% of their operation income is going to interests, which is not good. We are not happy with their debt either, but yeah. Quick ratio we talked about. Their quick ratio need to be higher. Something like 2 is optimal, but it's very low, something like 0.7. That's not good. So their retained earning, the earning that they kept every year, has been going down and down, and now it's negative. That's very bad. Their asset has been going up and up, but yeah, the problem was the asset was worthless. If the company goes bankrupt, it's not gonna be worth 600 billion. So this is not good. One of the things that are really important is return on invested capital. Previously, it was something like 26%, but since 2000, maybe 13, it has gone down to 4%, 8%. So the average is 7%. That's not good at all. We want it to be at least 15%, 20%. So this is not good either. Let's take a look at the net margin. So how much of their revenue they turn into income, and that's something like 8%. That's not good either. We want it to be something like 20%. Let's take a look at the earnings. So the earning was going up, then it went down and it stayed down. This is not good. It stayed around 25 billion. So let's take a look at free cash flow. Free cash flow is a little bit better than their earning, which is something like twice their earning. This is good. The problem is it was going up, then it came down, then it went up again. And the margin of their cash flow is around 16%. That's not good, but it's not bad either. But yeah, this is worrisome that some years they had way down. This is worrisome. And yeah, we talked about their cash position. So their cash position is something like 60 billion, and they have 300 billion in debt. That's very bad, because if something goes wrong, they have something like 60 billion of cash to pay this down. They are left with 250, and then their free cash flow is something like 40 billion. So it takes them something like 6 years to pay down their debt. And we want the company to be able to do it in 2-3 years, not 6 years, 8 years. And that's not good. And let's take a look at the dividend. So the dividend was going up and up and up, but the problem is the earning didn't go up and up and up. So they had to pay something like some years, 270% of their earning as cash to the shareholders. That's not good at all. So let's take a look at how much did they do that. So they had a net cash from operating activity of something like 30 to 40, and last year it went up to 100 billion, and they paid dividends, all of that as dividend, which we don't like. We like the business to be able to keep their cash and reinvest the cash, not give it to shareholders. Dividend is good, but yeah, not this high, because then it's not manageable. It seems that they're going into debt to give you dividend. So they're borrowing to give you money. That doesn't make sense at all. And the other thing that I don't like is their number of shares have been going up and up. So it seems that they are going into debt and they're diluting the shareholders, making the number of shares outstanding going higher. So they're selling the business and borrowing, and maybe they did it to buy other businesses. Maybe that's why the revenue has gone up. Maybe they didn't sell more products. They just bought other companies that sold more products. So this is not organic growth. It just went up because they bought some other businesses. And this is not good. This is something that we can do research on. So all in all, it seems that this is not a wonderful business. We are not going to pursue more of this company. But if we want to, then there is this link here to their website. You can tap it. And on every website for a public company, you can find some sort of investor relationship website. And go to their investor relation website and try to find the annual reports. So if you want to know more about the company, this is the place. We are going to come here and read all their annual reports. So they have 2022 to 2004. So we are going to read all of these. If we want to invest this company, we need to know all the things about this company. So you just tap this, open the annual report, and this is something else that is not good. So if you see images on an annual report, that means the company doesn't have good information to show you. They just want to impress you with nice images. I don't like that. This is just waste of time. Just give me some good information that I can read about the company, not some random images that doesn't make sense to be on annual reports. So this is not good either. So let's take a look and try to find if the company had bought some other company. Yeah, it seems that last year they bought some company called Alexion. So probably that's why they went into more debt and more shareholder dilution. And we don't like that. If the company has cash, just buy other good companies. But if you don't cash, don't dilute me or don't go into debt. And that was it for this session. If you like my video, please share it with your friends, like the video, subscribe to the channel. And if you have any questions, please comment below and I am happy to answer them. Have a great rest of the day. See you on the next one.